In this video, I'm going to talk about one of the greatest investment opportunities for beginners. Before we start, let me remind you that I am not your financial advisor. This is not financial advice, but this investment represents one of the largest in my portfolio and one of my highest in conviction investments. Before we talk specifically about the investment, there are really three things that we need to consider whenever we're talking about any investment. The first one is going to be risk and risk tolerance. The second one is going to be diversification. And the third is going to be growth potential. So let's talk about risk and risk tolerance. When we talk about risk tolerance, every person's born with their own risk meter. Some people are able to go cliff diving and they feel completely comfortable. They're able to go skydiving. Other people, they really have to do a cost benefit analysis before they cross the street. It's just every person is different and we all have different levels of risk, and that translates to investments. Take, for example, a stock like Tesla. I love Tesla. It's a great stock. Earlier this year, around February, Tesla was around $900 a share. And then it proceeded to drop over the summer to below $600 a share before rocketing back recently to almost $1,200 a share. A lot of people don't have the stomach for that type of risk, and that type of investment would just drive them crazy. It will make them buy high and sell low. Other people are completely fine with being up or down 20, 30% as long as they know that they really believe in that investment. So whenever you consider any investment, you have to consider your risk tolerance. The second thing to look at is what type of risk the inherent investment has. And this is where we look at single stocks versus, diversified portfolios. With one single stock, no matter how good that stock is, there's always the risk that that stock goes bankrupt, that company goes bankrupt. And if that were to happen, all the shareholders could potentially be wiped out from that event. There's really no company that's really too big to fail. So whenever we talk about risk, we have to think about that. The answer to risk is really diversification. And diversification, it allows you to spread your money across many investments, sometimes dozens, sometimes hundreds of investments. There are investment vehicles called mutual funds and ETFs that do a really good job of spreading that investment around into multiple vehicles. When we look at a ETF or an exchange traded fund, you could have a dozen, you could have hundreds of investment in a mutual fund or a ETF. And some of those investments, will have the same risk, but since there are so many, the chances of you losing the entire investment are much lower. Of course, there's a lot of styles and themes to ETFs and mutual funds. So you have to be careful because you can find yourself in an undiversified risk of related or undiversified basket of related companies. One of the main advantages to ETF besides their diversification is their low fees. When we look at the fee of an ETF or a mutual fund, we call that the expense ratio. One example of a ETF with a low expense ratio is the Vanguard's Total Stock Index, or the VTI. That tracks all the companies in the United States. There's over 3,000 companies in there, and it has an expense ratio of 0.03%. So what that means that if you had a $1,000 investment, you would pay about $3 with that type of an expense ratio of that $1,000. So $3 would go towards the fees, and that would be taking out of any potential gain or unfortunately any potential losses that you got. So the last thing to consider that we talked about is growth potential. And since nobody has a crystal ball to determine which of any investment is going to do the best, because if we did, we just put all of our money in the best and just every year we would change it out so we get the best investment. A lot of times we look at past investments to tell us about what may happen in the future. Now, I will say that past performance does not necessarily determine future performance. But I can tell you that it's a good way to look at what an investment has done to see what it potentially could do. Of course, situations do change over time. When looking back, one of the greatest investments over the last 50 years, 40 years is the S&P 500. And the S&P 500, it's a basket of 500 companies, 500 large cap companies in the United States. They're weighted by market cap, or what that means, market cap is the total value of a company. If you were to add up all the outstanding shares and put it together, that is the market cap. And when we look at the S&P 500 over the past 40 years, the S&P has returned over 3,661%. That average is about 10.9%, a 10.9% return on investment over the past 40 years. And while past performance doesn't necessarily indicate that the future is going to be exactly the same, 40 years averaging 10.9%, that's a heck of a track record that we have to look at. And the other good thing about the S&P 500 is it is diversified. We talked about diversity. If any of the 500 companies calculated in the average were to go bankrupt, it would just be replaced by another up-and-coming company. So you limit your potential loss of any one or even group of companies going bankrupt because of that diversity. Also, there are 11 sectors in the S&P 500. There are 11 different sectors of the U.S. economy, meaning that if one sector has a bad year or even, just completely gets wiped out, you have the other 10 sectors to balance that out. And just like this year, one sector may perform really great, next year another one will. They're all in the S&P 500, so you get the interplay of the winners, and you don't have to worry about being overly weighted for the losers. When I look at the S&P 500 and my investment, I've been investing in the S&P 500 since 2007, and my investment, at least my initial investment, and those older ones are up over 100%, meaning every dollar that I put in 2007 has more than doubled, and that's including the financial crisis of 2008, 2009, where a lot of us saw very large pullbacks in all investments, including the S&P 500. So without a doubt, if I were a new investor and I was looking to start, I would definitely look at the S&P 500 as my first or one of my first investments. It has a moderate level of risk because it has over 500 large companies. It's diversified across sectors and the 500 companies themselves. And it has a huge potential for growth because it includes companies that you've heard of, such as Apple, Google, Netflix, and of course, Tesla. So if you're new to investing, I definitely would look at that as one of the options. Also, if you're new to the investing and you don't have a platform that you've already been using, I would love to suggest M1 Finance. M1 Finance is very easy to set up. It's easy to use. It does a really good job of making it just simple. The entire process from start to finish is very simple. And right now, new users get $30 added to your account if you open a regular account with $100. So that's like a 30% return on investment on your first $100 that will help that grow a little faster. I'll be covering M1 Finance in one of my future videos. But for right now, you can look in the description. There's a link. If you click on that link, it'll take you there and it'll give you that $30 promotion as a reward. And also, I get rewarded when you select that from M1 Finance. So there's something in it for me too. But really, it's the ease. There's a million different platforms out there. M1 Finance is really one of the simplest ones to get you started. So thank you for watching. If you found this video to be informative, please take the time to like it and subscribe. And if you know anybody who's new to investment that needs to hear this message, please share this video with them. Thank you so much for watching, and we'll see you at the next one.